We're going to be taking a look at our Builder's Guide to Accounting. I want to talk a little bit about this. First of all, this is a book that you will use very little on a trade test. This book will become important on a business test. The only thing that I think you're going to have to do on a trade test is on page 24. At the bottom there's a percentage of completion equation. If you're taking the general builder or residential test, you'll want to know how to do percentage of completion, but that's really a separate video. I'm not going to go over that in detail while we go over this book. This book I won't be doing any math calculations. There are some separate videos which I show you how to do some payroll questions, some depreciation questions, the percentage of completion questions, and just a few other business type of math that you may have to do. But we'll just be doing the tabbing and highlighting in this particular video. And it's pretty basic. Also, another way that you'll know that you'll need to go to this book is if it's a pure accounting question. This is just about accounting. It's not about setting up corporations. It's not about licensing. It's not about your project management, or it's not about labor laws and all those things and lien law that you're going to find in the contractor's manual. It's not going to talk about AIA documents and what the contractor has to do and what the architect has to do. This is purely accounting. You're going to see, you're going to know when the question is going to direct you to this book. Pure accounting questions are going to come out of this book, or they're going to come out of chapter 3 in your Florida Contractor's Manual. So one of the two. I would go, if it was a pure accounting question, well, how do you know? Well, they're talking about inventory. They're talking about balance sheets. They're talking about different types of clearing accounts. They're talking about your income statement. You know what's an accounting question, what those key words are. Well, those are the things that are going to direct you to this book right here. And it's got a great index. So you're going to jump on that index. You're going to find it in here. If you don't find it in the index, it's probably not in this book. So then you can go to chapter 3 in the Contractor's Manual that's about financial management, or it might be somewhere else in that book. But that'll give you a little guidance on when you need to be thinking about this book. So let's take a look and do some tabbing and highlighting. Not the most exciting type of information in the world, but guess what? We have to pass that exam, so we are going to push our way through it. All right, so the first thing I want you to highlight is on page 8. Right-hand column on page 8. First, it's the second paragraph in bold print. It says sales. The sales journal is a detailed record of all your income from operations. That's your sales journal. Whoop-de-doo. Wonderful information for us to know. You'll be a much better contractor by knowing this information out of this book. Let's look at overhead expenses on the left-hand column. About halfway down, we'll go to that second paragraph under overhead expenses. Control of your overhead is important when estimating future jobs will often make the difference between profit and loss. Your record of past overhead expenses is the best indication of what you can expect in the future. Let's go to accruals on that right-hand column. Cash received and paid out in a business does not reflect the whole financial picture. Bills you sent out are income even before the cash comes in, and the bills you owe are direct costs or operating expenses even before you mail the checks. Okay, these billed accounts are a very real part of your financial picture at any time. Your books and records are only summaries of cash which has changed hands. The true and complete picture of your operation has to include adjusting entries, and these are called accruals. All right, let's see. Let's mosey on over to the next page. Page 12, the chart of accounts. Let's read about the chart of accounts. It's a numbered list of the accounts on your general ledger and operating statement. There you go. That's all you need to know about that. Let's go to page 15 at the right-hand column at the bottom. We're talking about assets. We got us a little We have something called double entry bookkeeping. Okay, you have double entry bookkeeping. It says the most common modern bookkeeping method is called double entry, and I doubt that any alternative method can be found to provide the same degree of bookkeeping control, yet remain as simple to use. It says in the next paragraph, double entry bookkeeping is so called because every transaction requires two entries, one debit and one credit. And it gives us a little sample down there. We're talking about assets. Believe it or not, assets carry a debit balance. It doesn't make any sense to me either. Hey, I'm a contractor, not an accountant, and I imagine you're not an accountant either. But you know what? You can pass it without being an accountant. You just got to answer it the way the book says. Use these sample balance sheets and these sample statements that they give us as a way to answer the questions. All right, so it says here cash and fixed assets and bad debt reserve. All these things are debit. They carry a debit balance, except for those. Hold on a second. The fixed assets, it says, is a credit. Liabilities carry credit. Why is that? Well, I guess it's because this is money that is going to come in at some point. Either way, make sure that you answer according to what the book tells us. Don't try to use your common sense when it comes to accounting, because there ain't nothing commonsensical about accounting if you ask me. But either way, we're going to look on page 17 of the right-hand column. We're going to talk about our financial statements. They're reports which express information summarized in the general ledger. The balance sheet, next paragraph, is one of the main financial statements. It's a listing of properties, assets, debts, liabilities, and ownership value, your net worth. There you go. Assets equals liabilities plus net worth. Let's go down to the bottom of that page. Right-hand column, last paragraph. The income statement, also called the statement of profit and loss, or the summary of operation, lists income, direct costs, operating expenses, and profit. While the balance sheet lists the balances in asset, liabilities, and net worth accounts on a specific date, the income statement reports the results of operations within a defined period, such as a month, a quarter, or a year. On the next page, on page 18, there's something called the statement of cash flows at the top left, or statement which is also called the statement of provisions of uses of funds. That's called the statement of cash flows. Let's drop down to that same column, left-hand column on page 18, last sentence. Last year's income compared to this year's will reveal the good and bad trends in the business and the increase or decrease in volume, expenses, and profit. There you go. That's chapter 1. Let's go over to chapter 2 on page, what page is this here? This is page 23, accounting methods. We are going to highlight the last sentence in that first paragraph. There are two accepted ways to record income: the percentage of completion method and the completed contract method. Let's talk about the percentage of completion method first of all. It says that contractors sometimes receive payments for work not yet performed or only partially completed. The portion of income above the degree of completion is said to be unearned. When you receive cash for work that's only partially complete, you have to separate that unearned income, assign it to a special account. There you go, not your back pocket. Next paragraph. This is known as percentage of completion accounting because you recognize as income only that portion of money received or charges billed for work that's completed. Next page. Second paragraph. The differences between billed or paid and true income can work the opposite way as well. This is a more common situation. For example, you estimate a job's 40% complete. You've billed out or been paid less than 40%. The difference has to be taken into account or accrued. There you go. Let's go to that last paragraph on that page, on the left-hand column on that page 24. Under the percentage of completion accounting, Your books reflect the effect of receiving payment either before or after it's earned. Let's go to the top right of that same page, second paragraph. The advantage of the percentage of completion method is that income and its related costs, expenses, and profits are recognized and reported as the job progresses. The term recognized refers to the accounting treatment of an amount. Let's go to the last thing on that right-hand column. That's that formula I was telling you about that you're going to need if you're taking the general builder or a residential trade test, and you're going to have to figure out the percentage of completion that you're finished on a job. Probably going to have to figure it out to do it on the business test as well. So make sure that you watch that video about how you figure out percentage of completion. Let's go to page 25, left-hand column at the top, your completed contract method. Recognizing income by the completed contract accounting method has the advantage of exactness. There is no need to estimate the degree of completion because all income is recognized only when the job is 100% finished. Next paragraph, you can use the completed contract accounting only when you'll complete a job within 2 years from the contract date and only if your annual gross receipts are under $10 million. There's also, I want you to find this next paragraph, percentage of completion capitalized cost method. The Tax Reform Act of 1986 created a new form of accounting called percentage of completion / capitalized cost method. Under this rule, you are allowed to use the completed contract accounting for only 60% of the total income and expenses of a job. The balance must be reported under the straight percentage of completion method. What the heck does that mean? I have no idea. Probably you don't either. But guess what? We know when we get a question about the percentage of completion / capitalized cost method, it's going to be right here. We're going to answer it word for word like the test question tells us to, and then we're going to pass this test and go on about our lives. Left-hand column on page 26, it says in the third paragraph that some contractors find the completed contract method meets their needs. Others adopted this method when they first began work and never bothered to change in spite of considerable growth. A small builder specializing in residential repair work can use the completed contract method because nearly all of his work is of short duration. But if the type of work he performs begins to include longer duration jobs, he may have a good reason to adopt the percentage of completion method. Let's go to the right-hand column at the top. Like many contractors, you'll probably want to use the percentage of completion method for long duration contracts and keep shorter jobs on a completed contract basis. Let's go to the bottom right of that same page. It says figure 2-2 shows the flow of adjustments for the earned income or asset account. Each month's entry consists of replacing the prior balances with the current month's balance. It may seem at first that it would be simpler to add the differences each month, to update the balance rather than to completely replace it. But it's more reasonable and easier to compare the year-to-date totals each month. Sounds good to me. Let's go to page 32, left-hand column, halfway down, cash and accrual accounting. Let's go to that second paragraph. The accrual system is by far the most accurate. Right-hand column at the top. As an alternative to the accrual system, you can also keep your books on a cash method. Under this system, you only record something in your books and records when money actually changes hands. This method isn't useful for any kind of comparative analysis by job because, as you know, the cash transaction is the last step in the deal and it could occur weeks or even months after the work is actually done. Okie dokie. We're going to flip over to page 38. Right-hand column, recording cash sales. List your cash sales by date so you can create summaries for the general ledger entries. Let's go to page 43, right-hand column, accounts receivable. If you drop down about 12 lines, I want you to highlight this sentence. The real value of a good receivables method is in the variety of information it provides. Let's go to page 44. We're going to look at the left-hand column and we're going to see that figure 3-6 shows manually prepared invoices and a billing statement. Invoices should show enough detail so your customer can identify the material and services and pay according to your terms. As we go to page 45, we're talking about tracking retrievables, and we're going to highlight the last paragraph on the page. The paragraph says, if retainages or similar withheld amounts become a major part of your receivables, set up a separate receivable account file for retainage in your general ledger. Let us see what it says on page 46. An aging list. Aging of accounts receivable. This is an aging list. It tells you it gives you a list of your customers and tells you how long they've owed you money. Let's go to that first full paragraph. Control the collection of accounts receivable with an aging list. Builders who are in close contact with their customers may know quite well who owes them money, but an aging list can still provide needed information and a written record of slow-paying accounts. The next paragraph says an aging list indicates what percentage of the total receivables is current and what percentage is past due. Let's go to page 54. On page 54, the left-hand column, last paragraph says, an excellent way to keep tabs on collections is to prepare an accounts receivables average length study. All right, you can do that if you like. Do that after you get through working about 12 hours. Go home and prepare an average length study. Yeah. On the right-hand column at the top on page 55, that first full paragraph says, so that's the first rule, stay on top of existing accounts. But there's another important part of receivables equation, prior qualification of new charge accounts. Next paragraph. Figure 4-2 is a credit application. Make it a company policy not to extend credit unless there's an application on file. That's not a bad idea. Right-hand column, page 59, it may help to offer incentive discounts such as 2% 10 days net 30. That means that the customer can deduct 2% from the invoice when payment is sent within 10 days of the billing date. Otherwise, it's all due. The whole amount is due in 30 days. I got to tell you this, you do need to understand this format. You got to understand what 2% 10 net 30 means, okay? That you do got to know. In the real world and someday, when you go take a test somewhere. Let's look at bad debt procedures. I want you to highlight the second, or actually third sentence on that page. Bad debts can be a big profit drain on your business. We all know that. Let's go down a couple of paragraphs. We're going to highlight just below those two bullets there. When an account becomes uncollectible, you must reverse the income you recorded previously. To do this, you write off an account in both the general ledger and on the customer's account ledger. You could write off the account on the sales journal itself, but that's not what most accountants recommend. Okie dokie. Do what your accountant recommends. That's what I recommend. Let's go to the top of page 64. For tax purposes, bad debts can be recognized only when a debtor's business is abandoned and worthless, he can't be contacted, or if he passes away and leaves a worthless estate. So, for a true bad debt, the possibility of collection must be just about non-existent. If a debtor dissolves his business but has net assets, his liabilities may be paid. If he moves away, you must try to contact him before you can claim that he has disappeared. And if he dies, the debt is transferred to his estate. Okay. Let's start reading at the bottom of that page, that column. It says, setting up a reverse for bad debts has the same important advantages. First, your books are useful to you only if they reflect what is really happening in your business. Your profit and loss statement each month should tell you how well your company is doing. If you don't reduce monthly profits by the bad debts you expect, your books won't truly reflect your profitability. Second, and perhaps most important, your business pays taxes on its profits at the end of each year. If you don't adjust your accounts for receivables, for bad debts that are sure to occur, you pay federal taxes, okay, and on profits that you will never see. For these reasons, most companies that have significant and regular bad debt write-offs set up a provision for bad debts. There you go. Good stuff to know if you want to pass this test, become a Florida State contractor, and really make something of yourself. There you go. So let's flip over a few pages as we go through. We're going to highlight Chapter 7. This is on page 79, and we're talking about sales planning. We're going to go to that first paragraph, and we're going to highlight that last sentence. The quality of your sales volume, not the amount, is the key to higher profits. All right, flip a page. Let's go to page 81. We're going to highlight on the left-hand side that first partial paragraph, last sentence. You should be aware of the increased risk before you commit yourself and your business. No kidding. All right. Let us see where we're at. We're on we're at the beginning of chapter 8, which begins on page 87. Planning for profits. That's what I want to do. Plan for some profit here. It gives us an idea. It gives us a little definition, a little, let's say. It talks about some jobs here, all right? You got the type of work, you have the volume, you have your profits, you have your yield, and it says underneath there the combined yield of work A and B is 6.5%. Because the work in C is losing money, it drags the total yield down to only 3%. There you go. So that's a -4. -4 and 5 is 1, plus 8 is 9. So this is a total of 9 over here. You divide that by 3, you get 3%. So it doesn't really matter. What they're saying here, if you get a math question, it doesn't really matter. Well, I guess it does matter what the volume is. They've got the same volume on all 3 jobs here. Either way, you take your profit and you average your profit on your jobs for that math question. Let's go to the next page, page 88, left-hand column. We have Graham Construction Company. Got a profit and loss statement. What's really cool about these sample statements is a lot of times you'll get a question and you can look at one of these sample statements and get your answer that way. All right. And it tells us we have our gross income, we're going to take our direct costs, then we subtract it from that, then we're going to have our gross profit, then we're going to take out our operating expenses, and then we get net profit. So that'll give you an idea of what's going on there. Well, let's see. Let's go to page 90, right-hand column. The relationship between volume and profit. It's important to understand the relationship between volume and profit. You should recognize this relationship when you decide to concentrate your efforts in one market and abandon another. The margin of profit increases with the volume if costs and expenses are a declining percentage of gross profits. All right. Let's go to page, let's see here. Skipping through a little bit, thank goodness. We're going to start next on chapter 10. We're going to be at the beginning of chapter 10, which begins on page 115.